Saving for retirement.
Yeah.
It's one of those universal challenges, isn't it? Can feel incredibly daunting.
Yeah, absolutely.
And the traditional advice, well, it often seems overwhelming or maybe just, plain outdated.
It often is. Things like save X%, max out your RSFP.
Right, or you need 70% of your pre-retirement income.
Yeah.
It's a lot of noise.
Yeah.
But what if that feeling, that outdated feeling, isn't just a hunch? What if it's, well, real?
Oh, it absolutely is real. The whole retirement landscape has shifted so dramatically.
So?
Well, think back. It used to be, relatively speaking, simpler. You had defined benefit pensions, right? Where your employer basically guaranteed you an income.
Okay, yeah. Those are pretty rare now in the private sector.
Virtually extinct. And on top of that, you used to have high, essentially risk-free interest rates. Today, those pensions are gone for most people, and real interest rates are, well, they're basically non-existent.
So the whole burden shifts.
Exactly. It transfers the entire responsibility onto individuals. We're far more reliant on the capital markets than ever before.
That feels like a really crucial shift. It's like the goalposts moved, but we're still using the old playbook.
That's a great way to put it.
Which is why today, we're doing a deep dive into Frederick Vettese's book, The Rule of 30, A Better Way to Save for Retirement. We've pulled out some, honestly, surprising facts and really actionable insights from his research.
Yeah, the book uses this dialogue format with an expert, Jim, talking to a young couple, Brett and Megan. It makes it quite accessible.
It does. So our mission here is pretty clear. Cut through all that noise and give you, the listener, a clearer, maybe more adaptable pathway to saving. We want you to get well-informed, quickly and thoroughly.
And the core idea really is that a lot of that conventional wisdom about saving might actually be, well, leading us down the wrong path.
Like that save X% advice. It just assumes everything stays the same financially.
Which it never does, right? Life isn't static.
Okay, so let's unpack this whole retirement savings conundrum then. You mentioned the variables. Just figuring out how much to save feels incredibly complex for so many people.
It really does. And that complexity, that overwhelm, often just leads people to, defer the decision, put it off, hope it gets clear later.
But deferring is risky, especially now.
Especially now. The reality of low returns makes it much riskier. I mean, Vettese points out, 30 years ago, you could realistically get maybe a 7% income in retirement just from a high-quality bond.
Wow, 7%.
Yeah. Today, you'd be lucky to get under 2%, and that's probably negative once you factor in inflation.
So the old math just doesn't work anymore.
Not at all. Not for this new financial reality.
So in this kind of environment, you'd think the big banks would offer some clear guidance, right? A solid rule of thumb.
You'd think. But Jim, in the book, found the opposite. Major Canadian banks, BMO, Scotiabank, RBC, they seem incredibly reluctant to actually endorse a specific savings percentage.
Really? What do they say instead?
Well, they might suggest really broad targets like 60 to 80% of your final earnings, or they make these kind of passing references to maybe 10%, but the language is super non-committal.
That's interesting. Kind of vague.
Very vague. And it's such a stark contrast to public sector pension plans, like for federal civil servants or OMERS. Those often require contributions of 20% of pay, sometimes even more.
Even with their, professional investment teams managing everything.
Exactly. So it raises this big question. Has the right percentage really jumped that high for everybody? Or are we maybe missing a more flexible approach?
And I guess this is where the paradigm shift comes in, this rule of 30.
Precisely. The core idea is revolutionary, in a way. Instead of saving a constant rate like that fuzzy 10 or 12%, the rule of 30 suggests you vary your saving percentage over your career.
Vary it. Okay, tell me more.
Well, the radical idea is that saving for retirement isn't always, or maybe shouldn't always be, your absolute highest spending priority, especially when you're younger.
Like when you've got huge costs like childcare or a mortgage.
Exactly those things. So a variable percentage means you have more spendable income when you really need it most, like in your 30s and 40s, but you still aim to save enough over your entire lifetime.
Okay, so what does that look like in practice, roughly?
The rough approximation Vettese gives is starting maybe around 5% of your pay in your 30s, then you ramp it up to about 15% in your 40s.
And then higher later on.
Yeah, then up to maybe 25% in your 50s. The whole point is to kind of spread out the pain of saving, if you want to call it that, across your working life.
Instead of making those early years, which are often financially tight anyway, even tougher.
Right. Makes sense, doesn't it?
It does intuitively. But, the question is, does this flexible approach actually work? especially if things get tough, like in a bad market?
That's a fair question, and Jim, the expert in the book, addresses this head on. He put the rule of 30 through a pretty serious stress test.
What did that involve?
He used what he identified as the absolute worst 30-year period for investments since 1938. That was the stretch from 1946 to 1975.
Okay, why was that period so bad?
Well, the average real return, so after inflation was only about 2.6% per year, compounded, tiny. And crucially, that period included the brutal 1973-74 bear market.
Worse than the 2008 crisis.
Actually, yeah. Vettese points out it produced bigger percentage losses than the 2008-09 meltdown. So a truly challenging scenario.
And how did the rule of 30 hold up?
Remarkably well. Even in that worst-case period, applying the rule of 30 still allowed individuals to accumulate pretty substantial savings, enough to provide a significant retirement income.
Wow. Okay, that's a pretty powerful demonstration of its resilience then.
It really is. It suggests the flexibility doesn't necessarily sacrifice the end result, even under pressure.
That makes a strong case for its practicality. But let's dig into another key piece Vettese talks about: understanding your actual spendable income, both now and what you'll need in retirement.
Right. He really challenges that traditional 70% retirement income target.
Yeah, I mentioned that earlier. He thinks it's too high.
He argues it's often way too high, especially when you factor in government pensions like OAS and CPP here in Canada. He actually asserts that 80% is far more than anyone needs.
Okay, so how do we get a better handle on what we actually spend and will need?
Well, you need to break down the major spending categories. Think about your mortgage.
Okay.
The payments are level in dollar terms, right? But as your pay hopefully rises over the years, that mortgage payment becomes a smaller percentage of your income.
Right, freeing up cash flow later on.
Potentially, yes. But then contrast that with something like child-raising costs.
Yes. Not small.
Definitely not. Vettese uses medium estimates from Ernst & Young, and they can be surprisingly high, and they often continue even when kids are in their mid-20s.
Mid-20s? Like what?
Cell phone bills, maybe helping with rent, that sort of thing. It lingers. And then, of course, you've got work-related costs that disappear in retirement and income tax changes.
So the critical insight here is that costs fluctuate a lot over a lifetime.
Exactly. They aren't static. So forcing a really high fixed savings rate early on when those other costs are peaking can be financially crippling.
Which is precisely why that variable rate in the Rule of 30 offers that flexibility.
You got it. Saving for retirement isn't happening in a vacuum. It's constantly competing with these other, sometimes fixed, sometimes fluctuating costs. You have to juggle.
Makes sense. And this juggling act, this understanding of fluctuating costs, leads into another concept that Vettese discusses, the idea of vulnerable years.
Yes, this is really important. Jim highlights this period late in your career, maybe ages 58 to 62, give or take.
Why are those years vulnerable?
It's the period when you might be forced out of your job earlier than you planned. It's kind of sobering, but the average retirement age isn't 65 like we often think. It's actually closer to 58.
58, wow. Why are people leaving earlier? Is it always by choice?
Not always. There can be employer motivations, maybe rising costs associated with older workers, sometimes perceived resistance to change, or unfairly perceived lower productivity. It happens.
Okay, that's a bit worrying. So how do you prepare for that possibility? This is where Jim offers some really interesting strategies, right?
Yes, two key ones stand out. First, he strongly suggests paying off your mortgage early, like say by age 57.
Why specifically paying off the mortgage?
He views it as a great idea because it provides crucial financial flexibility. If your income suddenly drops during those vulnerable years, not having that huge mortgage payment is a massive relief.
Okay, that makes a lot of sense. Less fixed overhead. What's the second strategy?
This one's maybe his most provocative piece of advice. It's about your kids.
Oh.
He suggests taking steps, starting when your children are young, to really foster their financial independence later on.
So teaching them about money early, setting expectations.
Exactly. He argues this could be the most important retirement planning advice he can give. Because if your kids are financially self-sufficient, it significantly reduces your financial obligations precisely when you might be most vulnerable financially yourself.
That is provocative.
Yeah.
Especially given the cultural expectation, certainly here in Canada, for parents to help kids with big things like a down payment on a house. Does he address that tension?
He does acknowledge it's a deeply ingrained practice, but he emphasizes the potential long-term strain that kind of help can place on the parent's own retirement security.
So it's not saying don't help, but prioritize your own oxygen mask first.
Kind of, yeah. His core point is about safeguarding yourself during those vulnerable years. Prioritizing your own financial footing by encouraging your kids' independence early on is a powerful way to do that. It lessens the chance you'll need to support them when your own income might suddenly stop.
Right, it builds in a buffer. Okay, shifting gears a bit. Let's talk investments. What's the strategy Vettese recommends for your actual retirement portfolio?
He generally recommends a target date fund approach, a TDF, the kind where the asset mix automatically shifts over time.
Okay, those are pretty common. Anything unique about his take?
Yes, he suggests weighting it more heavily towards equities, towards stocks, than the average TDF does.
More stocks. Why?
Mainly because of the current reality of super low bond yields. Bonds just aren't expected to deliver much return.
So what would that look like? Like how heavy on stocks?
Well, for example, he suggests someone who's, say, 30 years away from retirement could potentially be 100% in stocks.
Wow, 100%.
Yeah. And then gradually de-risking over time so that someone right at retirement might be closer to, say, 50% stocks and 50% bonds.
That's definitely more aggressive than many standard TDFs early on.
It is. And he's clear you can't be sure about future returns, but it's a strategy based on the current poor outlook for bonds.
Okay, so you get the asset mix right, maybe lean more into stocks early on.
Yeah.
But then there's always that temptation, right? Trying to time the market. Buy low, sell high.
Ah, yes, the siren song of market timing. Jim tells a really compelling story in the book to illustrate the pitfalls here.
The Stella and Audrey story.
That's the one. So Stella is portrayed as this incredibly successful market timer. Over 20 years, from 1996 to 2015, she almost perfectly buys near the bottom and sells near the top. Amazing timing.
Okay, so she must have done great.
You'd think. But then there's Audrey. Audrey just stuck to a consistent, kind of boring 60% stock, 40% bond mix throughout that entire same period. No timing attempts at all.
And don't leave me hanging.
The surprising outcome. Audrey's plotting, consistent portfolio actually outperforms Stella's almost perfectly timed one over those 20 years.
Wait, really? The consistent one won? How?
Well, the key takeaway isn't just that timing is hard, which it is. It's virtually impossible to sell at the very peak or buy at the very bottom, as Vettese puts it. But the real aha moment is that consistency, just staying invested in a diversified way like Audrey did, often captures more of the market's upward movements.
Because you're always in the game, even if you don't hit the absolute tops and bottoms.
Exactly. Missing even a few key months or weeks of market recovery can totally negate any benefit you thought you got from timing. It's a powerful argument for just staying the course. Patience pays.
That's a fantastic illustration.
Right.
Okay, so consistency over timing. What about real estate, specifically rental properties as a retirement investment? That's something a lot of people consider.
It definitely has appeal, yeah. The idea that rent covers the mortgage and expenses, maybe you get some cash flow, and then eventually you sell for a big profit.
Sounds good on paper. What does Vettese say?
Well, Jim runs through two scenarios for a hypothetical $400,000 condo investment. There's an optimistic one.
Let me guess. Property values soar, rents are high, interest rates stay low.
Pretty much. Values rise 3% faster than inflation, low rates. Yeah, it looks very profitable in that scenario.
But there's always a but.
There's always a but. He also runs a pessimistic but still quite plausible scenario. Think frequent vacancies, maybe higher than expected repair costs, and crucially, interest rates rising back up to, say, 5%.
And in that case?
In that case, you could actually face real losses, or maybe just break even after all the hassle.
So it really hinges on things going right. And this brings up leverage, right?
Yeah.
Using borrowed money.
Absolutely critical point. Leverage the mortgage is what makes those optimistic scenarios look so good. It amplifies your returns, but it's a two-edged sword.
Meaning it amplifies losses too.
Exactly. If the market turns down, leverage can mean you lose your entire investment or even end up owing money. He points to historical examples, like the real estate collapses in Vancouver and Toronto back in the late 80s, early 90s, lasting till about 2000. Leverage was brutal then.
So rental properties aren't a guaranteed win for retirement. Needs careful thought. What about just owning your own home, your primary residence? Renting versus owning.
Yeah, they look at that too. And historically, owning your primary residence has generally been the better financial bet here in Canada, pretty much since World War II.
Generally better.
Yeah.
But could that change?
It could. Factors like, say, significantly higher mortgage rates than we've seen recently, or maybe lower price appreciation, or even just rents not keeping pace with house prices.
Yeah.
Those things could potentially tip the scales more towards renting being financially comparable or even better in some cases.
But it's not just about the numbers, is it?
No, and Jim acknowledges that. There are really important non-financial reasons people value homeownership. The choice to customize your space, the feeling of stability, just making it your own. For a lot of people, that outweighs the pure financial calculation.
True. Okay, let's pivot to forecasting. Looking ahead is always, well, a bit fuzzy.
Definitely tricky. And Jim warns about the biggest forecasting pitfall, giving undue weight to the immediate past.
Meaning we assume recent trends will just continue indefinitely?
Exactly. We tend to be overly influenced by what just happened and kind of dismiss the more distant past as irrelevant.
But does that mean forecasting is useless? Should we just throw up our hands?
No, not at all. He argues the future isn't a total mystery. Well, tiny random events, the butterfly wings effect, can affect short-term outcomes. Bigger things, major shifts like demographics, can often be anticipated to some degree.
So trying to forecast, even if imperfectly, is better than not trying at all.
That's the idea. Especially for long-term planning like retirement, you need some kind of outlook.
Okay, so what are some of the key economic forecasts Vettese outlines in the book? Let's start with inflation.
Right. So the Bank of Canada has its 2% target, and they've actually been incredibly successful at hitting it over the long run.
But Jim has some concerns.
He does raise concerns about potentially overshooting that target, mainly due to the massive government and central bank responses we saw, for example, during the COVID-19 pandemic. That much stimulus could push inflation higher.
But he also mentions the opposite possibility, deflation.
Yeah, which is really interesting. He introduces the possibility of deflation where prices actually fall over time. He points to Japan's experience since the 90s and even historical periods in the US and UK.
And why might deflation happen?
His main argument is the aging population. Older populations tend to spend less, which can drag down demand and prices. So it's this kind of dual possibility, maybe higher inflation, maybe deflation.
Which obviously has big implications for planning. What about wage increases? Will our pay keep up?
Historically, like in the 40s through 60s, wages tended to outpace price inflation by maybe 2% a year. Good real wage growth.
But that changed.
Yeah, that gap narrowed quite a bit. Looking ahead, Jim forecasts more moderate wage growth, maybe just 1% faster than inflation.
What's driving that slower growth outlook?
It's a mix of things. You've got baby boomers leaving the workforce, which could push wages up, plus technology gains. But those might be offset by factors like the growing income gap and maybe the impact of AI.
So for planning, it suggests our income will likely keep pace with costs, but maybe not race ahead like it did in the past, makes saving potentially harder.
Could do, yeah. Less room for significant real wage gains to boost your savings rate easily.
Okay, now bonds. You mentioned earlier they're not looking great. Can you elaborate?
This is really critical.
Huh.
The reason bonds delivered such great returns over the last 40 years or so is because interest rates fell dramatically, like from 15% down to almost 1%.
Right, falling rates mean rising bond prices.
Exactly. But that game is over. Rates can't fall from 1% to minus 14%. You simply cannot replicate that kind of massive drop.
So because rates are already so low.
The potential for future returns is much, much lower. Jim actually forecasts a negative real yield for high-quality bonds, maybe around a minus 0.25%.
Meaning after inflation, your bond investments might actually lose purchasing power.
That's the forecast, yes, which really reinforces that idea of needing a more equity-heavy portfolio, like the TDF approach he suggests.
Okay, that ties into the next big point, which you touched on. The real reason for these low interest rates.
Yeah.
It's demographics, right?
Yes, this is such a powerful but often overlooked factor. Jim explains it really clearly by dividing the population into two main groups.
Savers and borrowers.
Exactly. Savers are typically older, say age 55 to 80, accumulating capital, looking for safe places to put it. Borrowers are younger, maybe 25 to 54, needing capital for mortgages, starting businesses, raising families.
Okay, so what's the key insight there?
It's the ratio between these two groups. As populations age, the proportion of savers grows relative to the number of borrowers.
So more people supplying capital than demanding it.
Precisely. You get more capital supply than demand, and basic economics tells you that pushes the price of capital interest rates down.
And this isn't just a theory. There's evidence.
Oh yeah, tons of it. Vettese shows how this pattern played out in Japan, across Europe, and in the US. As their populations aged, their interest rates fell, often sooner and faster than people expected based on other economic factors alone.
Even places like China.
Even China is aging rapidly now and seems to have crossed that critical threshold where savers start outnumbering borrowers, relatively speaking. It's a global trend.
So for us, planning for retirement, this means we should probably expect a future of generally lower interest rates than maybe our parents experienced.
That seems to be the strong implication from the demographic trends, yes. And that impacts everything: mortgage rates, bond returns, annuity rates, everything.
Wow. That's a really fundamental point. Okay, what about the last big asset class?
Stocks. Stocks. Jim calls them the untamed stallion. They're the most difficult to predict, the most volatile.
But what's the general outlook, given current conditions?
Well, current conditions include pretty high price-to-earnings ratios, PE ratios, meaning stocks look kind of expensive relative to their profits, historically speaking.
Okay.
And also lower equity risk premiums. That's basically the extra return you expect to get for taking the risk of owning stocks compared to safer bonds. If that premium is lower, it suggests future stock returns might also be lower than their long-term historical averages.
So putting all these forecasts together, inflation uncertainty, moderate wage growth, poor bond outlook, likely lower stock returns, all driven partly by demographics. What's the overall picture?
Yeah, the sobering conclusion Vettese reaches is that compared to typical historical periods, the future doesn't look as good as the past in terms of investment returns and maybe real wage increases.
That sounds a bit grim.
It sounds sobering, for sure, but doesn't mean retirement is impossible. It just underscores the need for really smart, adaptable planning like the Rule of 30, rather than just relying on historical averages that might not hold true anymore.
Right. Be realistic about the future environment. So the Rule of 30 is a great starting point, especially early in your career.
Yeah.
But you mentioned fine-tuning later on.
Absolutely. Jim emphasizes that when you get closer, say within 10 years of your planned retirement, it's really time to get more specific than a general rule of thumb.
And he recommends a tool for that.
Yes, a free online tool called PERC, which stands for Personal Enhanced Retirement Calculator. You can find it at perc.morneaueschapelle.com.
PERC. Okay, who is that for?
It's designed specifically for people aged 50 to 80. It lets you input your specific assets, your expected retirement age, ongoing contributions, and it gives you a much more personalized estimate of your likely retirement income. It goes beyond the rule of thumb.
That sounds incredibly useful for that later stage planning. Now, what if PRC, or just your own calculations, show you're maybe a bit behind schedule in those later years? Are there ways to catch up?
He suggests two main strategies if you find yourself needing a boost near the end. One is a pretty focused savings effort.
Like saving even more.
Yeah, saving an extra 10% of your pay. So on top of the 25% from the Rule of 30, bringing your total savings rate up to maybe 35 or 40% just in those last 5 working years.
Wow, that's a big chunk. Does it make a difference?
He shows it can significantly raise your spendable income throughout retirement. It's a concentrated push at the end.
Okay, what's the other option if saving that much just isn't feasible?
The other main way is tapping into your home equity.
How? Selling the house.
That's one way. Downsizing to a smaller, less expensive place frees up capital. Or if you really want to stay in your current home, you could consider a reverse mortgage.
How do those work again?
Essentially, you borrow against your home's equity, but you don't make any payments. The loan, plus accumulated interest, is repaid later, usually after you pass away or permanently move out, typically from the sale of the home. It provides income or cash while letting you stay put.
Got it. And one last thing on income sources, government pensions.
Yeah.
CPP and OAS, you mentioned them earlier. Any key updates or points there?
Just a quick note that the Canada Pension Plan, CPP, has been undergoing a pretty significant expansion since 2019. It's being phased in gradually, fully in place by around 2070.
So future retirees, like the Brett and Megan couple in the book, will get more from CPP.
Significantly more, yes. It's designed to replace a larger portion of pre-retirement income. And also, it's worth remembering tax strategies using TFSAs and non-registered savings smartly can help avoid having your OAS payments clawed back if your retirement income ends up being higher.
Right, those clawbacks are important to manage. Okay, so wrapping this all up then, the core message seems to be, yes, saving for retirement is absolutely crucial. You have to do it.
No question.
But maybe it doesn't have to overshadow enjoying every single phase of your life, especially those expensive younger years. The Rule of 30 offers a way to sort of distribute the financial pain or effort of saving more evenly.
Exactly. It's about adapting to life's changing demands while still building that secure future. It makes saving feel less like an immediate burden and more like a manageable long-term strategy.
So a final thought for our listeners to chew on, building on this deep dive.
Well, thinking about that profound impact of demographics we discussed, how it's reshaping interest rates, potentially growth, Maybe consider this. How might your own choices about how long you plan to work, maybe family planning decisions, even where you choose to live, how might those personal choices unexpectedly intersect with these big macro demographic trends to shape your retirement realities beyond just your savings rate?
Hmm. That's interesting, thinking about how our individual lives connect to those massive, slow-moving forces. Definitely something to mull over.